Hello and welcome to BQ Prime. A very good morning to all the viewers. You're watching Stocks in Focus and I'm Hiral Datia. Nexus Select Trust, that's a company we are focusing on. Clearly, a consumption surge has continued across assets. If you talk about the like-to-like consumption growth across its urban consumption centers, that is malls, that has seen a growth of almost 18%. And this is pretty much similar to what the company achieved in the first quarter of FY24. To discuss more on the trajectory from here on, joining us on the show is Dalip Sehgal, Executive Director and CEO at Nexus Select Trust. Good morning and welcome to the show, Mr. Sehgal.
Morning, and thank you for having me.
Always a pleasure to speak to you. Mr. Sehgal, my first question coming to you is the consumption surge that has continued across asset classes. Is this something which is expected to continue?
So the fact is that I think the first half of the year has gone up very strongly. The quarter three start also has been good. As you know, the festive season this year has actually got shifted. So there is the Sera that happened in October and the Diwalis happened in November, unlike last year, where both festivals fell in October. So like for like comparison for October would not be fair. But if you look at October plus November, I think we're still looking at a strong double-digit growth. So the quarter three numbers also seem to be going pretty well as of now.
Right. Now, overall, if you see from a NOI CAGR growth, how much are you looking that to grow with? Because clearly, second quarter it's grown at around 17% on a year-on-year basis. If you have to take a CAGR growth over the next 2 to 3 years, do you think 17 is what, or 15 to 17 is the range, or will it be lower double digits?
So we had basically going back to the DOD at the time of the IPO. What we had projected over a 3-year period was actually 8.5% CAGR growth on NOI. So all the projections that have been done at the time of the IPO have been done with an 8.5% CAGR growth on NOI. Our own estimate is that seeing what's happened so far, I think we'll probably do better. So far, we are ahead of projections in FY24, and we hope to continue that.
Okay. So with this, are you expecting the contribution to come in from ramp up in occupancies in existing assets, or will it be the annual rental escalations or markup of leases that are expiring? What of it will contribute to this kind of growth?
That's an excellent question. Yeah. So all three are important. If you look at organic growth, it essentially the NOI growth. It consists of, like you said, rental growth. So if you look at the first half of the year, we've actually done almost 200 plus deals. The uplease is at 24%. So whatever we've released has seen an escalation of 24%. In addition to that, all leases have a 15% escalation over 3 years, which means 5% escalation every year. In addition to that, we have what we call a revenue share. So any lease would have a revenue share clause as well. So if, let's say, the brand or the tenant does better than X in terms of revenue, there's a revenue share percentage as well. Out of the total rentals, about 13% comes from revenue share. So if you look at all these three components, which is increase in contracted rents, which is 5% a year, look at roughly 20-25% escalation at the time of releasing, and an increase because our top line growth has been 18%, so the increase in revenue share is also significant. If you put all of that together, you are looking at double-digit growth in rental for sure.
Okay. Overall, from here on, if you have to look at the second half, will that be stronger than the first half of the year?
Difficult to say. I would say that in terms of how the current quarter is going, I think there is continued demand. So I think what's important for us is not just looking at the second half, but to see a trend. And if you look at the last 4 quarters, I think the demand post-COVID has been strong and continues to be so. So there are categories that are doing extremely well. If you take, for example, entertainment, F&B, food and beverage, take electronics, all these categories have grown significantly higher than the 18%. The only laggard so far in the first half of the year was fashion, and there the consumption growth has been around 8% odd. From whatever we can see, I think because of the festive season, etc., and old inventories having run down, I think even fashion will come back quite strongly. Already we are seeing signs of that in November. So once that picks up, I think overall the growth should be equally strong in the second half of the year.
Okay. If I have to talk about a certain sector, if specifically from a festive season perspective, how has the consumption pattern and footfall been during the Sera, Diwali as compared to last year?
Right. So if you look at the footfall growth in the first half of the year, it's 14 odd percent. Uh, Unlike last year in FY23, there's hardly any footfall growth. So post COVID, we saw a 20% plus kind of a growth in terms of revenue, not led by footfalls, but led by spend per footfall. This year, footfalls have grown 14 odd percent, which essentially means that families have come back, entertainment has done well, movies have done well. So that also adds to the footfalls as we go forward. Looking ahead at the festive season, whatever has happened so far, I think the Diwali season still continues. There is still a lot of festivity happening around. So footfalls have been good, but like I said, it's a little difficult to compare with last year, which had both festivals happening in October. This year is between October and November. So the way we are looking at it is to look at both the months, October plus November this year versus October plus November last year. There, I think the footfalls, the growth in footfall will still be strong double-digit growth.
Okay. And if you have to talk about international brands like Pret a Manager, Mangor, they are gaining prominence as well. So, how do the rent yields actually differ with regards to domestic brands?
I think it's not just about international and domestic brands. I think it's really about affordability of rentals. So the way we look at rentals is not in isolation. We look at rentals as a percentage of sales. So the criteria that we have really is what is the affordability for a particular brand, whether it's Pret, whether it's Paul's, or it is any domestic brand. And category by category, it can be quite different. So, for example, a supermarket which works on low margins will be able to afford a much lower rent to sales ratio than, say, jewelry, which can afford a slightly higher rent to sales ratio. So, it depends entirely on the category. I don't think it's just about international and domestic brands. A coffee brand, for example, would be able to afford higher rent to sales ratio, and that's the way we look at it. We, in fact, constantly every quarter we look at sales and see what is the ratio that the brand is paying and is that affordable or not. And I think that's how the rents are calibrated. They're not calibrated on is it an international brand or is it a domestic brand.
Right. If you have to look at the next 2 to 3 quarters, how much office space land is being commercialized, number one, and released, and what would that yield look like?
So first of all, 91% of our business actually is retail. Those 17 malls, 10 million square feet. That is our core business. About 3% is office. Another 3-4% is the hotel business. Both of which are doing well. So the materiality of that is very limited. But what I can tell you is that the limited, we have about 1.5 million square feet. We don't buy offices separately. We don't build offices separately. These are offices that came as part of an acquisition of a mall. So take Ilanti in Chandigarh. It had a Hyatt hotel. It had offices and it had the mall. When we bought the mall, the hotel and the offices came with it. So our core business is not either hospitality or offices. But like I said, both of them are doing well. In fact, hotels are probably at an all-time high. And in terms of offices, I think our current level of leased occupancy is upwards of 85%. So, yeah, that's really what it is.
Okay. With this, you have announced a NDCF DPU of around 2.98 per unit for the first half of FY24. Are you on track to meet the distribution estimates of around, say, 7.6 a unit in FY24 as a whole?
100%. So if you extrapolate it, this is around 8 odd percent. And look at our NOI, it is ahead of projection. consumption is ahead of projection, re-leasing spreads are ahead of projection. So all financial numbers actually in the first half of the year are ahead of projections. And 2.98 actually is certainly in line, if not a bit ahead of the full year projection. May I also say that 72% of this is going to be tax free in the hands of the recipient, primarily because there are two components to it. One is the dividend, and the other is return of capital. That's 62 plus 10, 72 is actually going to be tax free, which is exactly what we had projected at the time of the IPO as well. And the balance 28%, which is interest, will be taxable. So, from a tax perspective as well, this is perfectly in line with what we had projected.
Okay. Now, if you have to look at the debt profile, the net debt is around 3,500 odd crores. You do have a debt headroom around $1 billion as well, right? Now,
Yes.
one, are you comfortable with the current debt? And two, uh, taking into consideration the headroom that you have, what's the expansion plan looking like? Because you already have a couple of term sheets signed to acquire 3 malls in southern India as well.
Yes. So I think again, in terms of where we are on the debt side, our LTV is at 14, which is really lower than what we had projected, and certainly much lower than most of the REITs. Most REITs in India operate at 28 to 30% LTV. We are at 14, and you're absolutely right. The headroom is $1 billion that we could still borrow. Do we need to borrow all of it just now? The answer is no. As far as acquisitions are concerned, yes. Uh, we have, like you said, a term sheet signed for these three properties, and there are more as well on the table, and hopefully some of them will get converted soon. But I think the moot point is that when we acquire, there are two ways that we can actually, agree on how to pay the seller. We could pay full cash, in which case the debt component comes in, or it could be a combination of debt plus units. So there are people like Select, for example, who rolled it to the reach, and that was 100% unit exchange transfer. So it depends entirely on how the seller wants it to be done. But from a financial perspective, I think the headroom for growth on the debt side is very, very significant. We are not highly levered at all. And to your question, is the current level of debt comfortable? I think it's more than comfortable, lower than the projection. And I think we have the ability now to complete some acquisitions soon.
Okay. And clearly, if you have to look at the next milestone that the company wants to achieve, what would that be?
To meet our projections, I guess, yeah, that's the first milestone. For FY24, there's a projection that we have done, which is, like you said, a 7.5% distribution in terms of what we give our unit holders. I think we are well on course to meeting that. There was a target in terms of top line growth and profit growth. I think we are on course to do that. And we had also said that we would continue to acquire because the business model is one of acquisition. We do not build malls as of today. All the 17 that are there in the portfolio, hotels, offices, are all acquired. None of them have been built. So our intent, even at the time when we went into the market, was that we would continue with the acquisitions, and that fortunately, the way it is looking like is that the inorganic growth also will be in line with what we thought we would do when we launched the IPO.
I think lots brewing and lots for us to watch out for as well. Thank you, Mr. Sehgal, so much for joining us on the show and share the view. So that's with regards to where Nexus Select Trust goes. Clearly, pretty much on track with regards to meeting their guidance for FY24. But let's quickly take a look at what markets are doing at this hour. Overall, if you go to see in terms of Nifty 50 as well, a good recovery that did come in from the day's lows, or I would say from opening lows. We are now nearly at the 19,770 mark, below the 19,800 levels, though. It has been a volatile ride. We've hit a low of around 19,667 in intraday trade. With regards to Bank Nifty, that continues to remain under pressure. A little over 450 points is the kind of cuts that we are seeing with regards to Bank Nifty. In fact, the cuts with regards to where the PSU Bank Index is concerned, that is way higher as compared to the Bank Nifty as well. A few of the stocks that we should be watching out for: delivery. The volumes are up almost 32 to 33 times, and this is on the back of the block that we saw where SoftBank went ahead and sold stake. Rosary Biotech, strong volumes on that one as well. SBI Cards and Payment Services. Now, that is one which has been trading under pressure on the back of the RBI guidelines with regards to making more provisions is concerned, and the volumes are high on that one as well. As well as you have a PCBL, which is seeing 3 times its 30-day average. So that's the volume buzzers that we are watching out for. But moving on, another stock, CAMS, that's been in focus as well. If you see in terms of what's happening with CAMS from a stock price perspective, today it's down 0.4%, but in the last 5 trading sessions, 15 to 16% is the kind of up move that we have seen. Anuj Kumar, MD at CAMS, joins in. Anuj, good morning and welcome to the show.
Hey, good morning and thanks for having me over.
Always a pleasure. My first question coming to you is, overall, from a business perspective, how has the second quarter been? Because we have seen historic highs, right? Revenues up 10%, profit number at around 81 crores. Margins have seen a strong growth as well. What's working?
I think after a lapse of time, we had a strong growth quarter. Our mutual fund assets grew about 20% year on year. Equity assets actually grew 28%. Our share in net sales, which is a metric which shows how much net money investors are pouring into the mutual fund markets, was 80% in the equity segment. So we saw the overall shares hold quite well. Our overall MF AUM share held at about 68.5. Our equity share crept up to about 65.5. So on the back of all of these rising numbers, sustained inflows, and I think strong mark-to-market gains, it was inevitable that we would see a strong quarter from an MF perspective. Overall company revenues grew about 13%. PAT, you saw, came up about 17% plus. So overall, very satisfying.
Right. Now, overall, on a sequential basis, if you see, the yield was impacted. Though this was on the back of the residual impact of the price resetting. But is this expected to be a factor going ahead, or is this something which can be eliminated?
Small yield compressions, I think, are just a spine to this industry, so that will continue. The reset that we've spoken about was a one-time reset, which we adjusted completely in the last quarter. So I think we've seen the impact and there should be no further impact, which means it'll be about a 2 to 3% price contraction every year, but nothing more than that.
Right. Now, in terms of the non-mutual fund revenue, the traction was strong with material embedded value as scale is achieved, right? Now, from here on, how do you see this business segment performing, and what does the potential look like from a revenue contribution as well as a margin perspective?
So if you see, non-MF has been a very good story in the last 1 year. Revenue contribution of non-mutual funds grew from 10% of the overall revenue book to 13%. Non-MF as a segment grew over 45%. If I take out the impact, the one-time impact of the revenues, which was acquisition revenue of Think Analytics, it still grew 30% on constant base. Our KRA revenues grew over 100% during the last year. Quarterly revenue year-on-year basis. So when you see a portfolio of non-mutual funds, which are largely led by, I would say, 3 franchises, alternatives, CAMS payments, and KRA, I think that's been a pretty good story. We have other businesses in insurance repository, account aggregator, and then all the revenue that we are now making in the non-capital market side through Think Analytics, because they're mostly on the lending industry side and they do business insights and analytics kind of work. I think we are firing on all cylinders, and you will continue seeing the impact in the ensuing quarters and years.
Okay. Now, if you have to look at the AIF yield, are you seeing any trend in terms of movement to AUM linked revenue model?
The AIF industry isn't very similar to the mutual fund industry, which means a lot of these are fixed fee contracts. Some of them are BIPS based, similar to the MF industry. I think in general, it's become more competitive in the last 2 years. So, always when an arena becomes more competitive, you see some price erosion. I think we've seen that in the past, and now we should be seeing a more constant fee environment.
Okay. So, overall, from here on, what is going to be the growth driver and the milestone that the company wants to achieve?
I think we've said this in the past that we want to be good, strong, stable, 15% kind of earnings compounders. We've stated that given the backing of about high teens to mid teens mutual fund asset growth, we expect the MF revenue to continue scaling at about 12 to 13%. We expect non-MF to grow over 20%. So, on a blended level, about 14 to 15% revenue growth. With some increased efficiency and productivity, profits should grow higher than 15%. So that's really the broad outlook that I would place for you.
Okay. Another question I have for you is from a markets perspective, between mutual funds and equity, right? If you have to divide that, how is the retail participation coming along? Where are you seeing traction?
See, broadly, there have been a lot of millennial kind of consumers who stepped, kind of leapfrog directly into the direct equity market and not stepped into mutual funds. Otherwise, the normal progression is that you move from fixed income to mutual funds to direct equity. I think in the mutual funds arena, getting in about 4 to 5 million new consumers has been, a strong trend for the industry, which will continue. The industry has seen very large SIP collections, and you're seeing these numbers, which grew from about 7 to 8,000 crore a month in the COVID phase to upwards of 17,000 crores, so about doubled in 3 years. And if you see the same trend, which means that the number can again leapfrog 2x in the next 3 to 4 years, I think it just gives a very strong, vindication of the retail participation in the MF industry.
Right. So I think there is something which is brewing from a markets perspective as well. Thank you so much for joining us on the show, Anuj, and sharing the views. So that's the management of CAMS. If you see from a stock price performance as well, in the last 1 year, around 20% is the kind of moves. Majorly, the upside has started to creep in from May onwards, and that's the story coming in so far. That's all that we have on this session. Thanks for watching, and lots more lined up on the other side. Please stay tuned to BQ Prime.